This is a video for Finance 303 with Professor Dow, and I'm Jim Dow. It begins the part of the course that covers the role of finance in a business plan. In this video, we'll look at how to use financial ratios to look at the financial health of a company. Financial statement analysis is pretty much just what it says, the study of a company's financial statements to determine the past and future performance of the company. At this point, you should be familiar with the three basic financial statements: the income statement, the balance sheet, and the statement of cash flows. In this presentation, we'll look at how you can use information from these statements. In practice, financial statement analysis can be very involved, with the particulars depending on the specific industry that the company is in. For this presentation, we will focus on the basic process of financial statement analysis. In particular, we will go through various commonly used financial ratios. You will need to know these ratios for the midterm. You should know how each ratio is calculated, or if given the ratio, you should know its name. Why do we do financial statement analysis? Financial statements are important for a number of reasons. Companies have to keep records to determine their tax obligations. Internally, managers of the company might be interested in questioning how efficiently the company is run and whether there might be some way to improve that. External investors would also be interested in the financial condition of the company. Someone who is interested in buying the company's stock might want to know how profitable a company is and how that might change in the future. A bank that is considering lending the company money to finance an expansion would want to know if the company will be able to repay the loan in the future. When studying financial statements, it's typical to express the numbers as ratios. In fact, sometimes the term financial ratio analysis is used in place of financial statement analysis. The reason for this is that ratios put the numbers in context, which makes them more informative. To see how this works, let's look at an example involving debt. We are potential investors in XYZ Corp, and we want to know if it has an excessive amount of debt. As we'll see later in the course, how much debt a company should have is actually a complicated question. But at this point, we just want some idea whether the company has a lot of debt or not. We go to the balance sheet, and we see that XYZ Corp in 2015 had $80 million worth of debt. Is that a lot? It depends. If this is a small company with earnings of $2 million annually, we'd certainly be concerned about whether it could pay the interest on the debt. On the other hand, if this is a very large company, with most of its financing coming from equity rather than debt, we might not be so concerned. To put the debt in context, we'll compare the amount of debt with the total assets of the company. Since assets on the financial statement will equal the sum of equity and liabilities, this will tell us the relative importance of debt in financing the company. Calculating this debt to assets ratio, we get a number of 0.8. That is, 80% of the company's financing comes through debt. But now we're left with the question, is 80% too much? We need to pursue things further. One way to put things in context is to compare XYZ's ratio with those of its competitors. It's typically better to compare XYZ with competitor companies rather than with all companies in general, since competitors will likely face a similar business environment. For example, they may face a similar level of earnings risk during an economic downturn, which can be important in determining the appropriate level of debt. Here are the debt to assets ratios for XYZ and its three main competitors. We see that XYZ is using more debt than the other firms. Is that bad in itself? Not necessarily, but it does suggest that we ought to take a closer look. If we found that XYZ had the same amount of debt as its competitors, would that mean everything is okay? Again, not necessarily. The entire industry might have too much or too little debt. But comparing XYZ with its competitors provides some insight into the company's strategy towards debt. Another way to put financial ratios in context is to see how they've changed over time and whether there is any trend. In this case, we see that XYZ Corporation's use of debt has been increasing over time. It's likely that a continued increase would be unsustainable, so we would want to look at why the debt has increased in the past and whether the company expects to increase their use of debt in the future. A convenient way to compare the financial statements of different companies is to create what are called common size statements. With common size statements, we express all the values on the financial statements as ratios. On the income statement, we divide each item by the amount of sales or revenue. Another way of saying this is we scale each item by sales or revenue. Balance sheet items are divided or scaled by the amount of assets. In this example, we are comparing two companies, XYZ and DEF. DEF is a much larger company with 3 times the earnings and twice the amount of debt. But we want to know which company has the higher profit margin and the most debt, controlling for size. On the left-hand side are the standard financial statements with a simple income statement for both companies on the top and the balance sheet on the bottom. We can see that DEF has greater earnings and more liabilities, in other words, debt. On the right are the common size financial statements with which we want to compare the two companies. We divide the income statement items by revenue, which shows that profit margin, earnings divided by revenue, is greater for XYZ, even though the dollar amounts of its profits are less. We divide the balance sheet items by assets, which shows that DEF uses proportionately less debt, even though the dollar amount of debt is greater. Financial ratios by themselves almost never completely answer the question we're interested in. Financial statements are a great way to quickly look at a number of different variables. However, they often lead to additional questions. Once we've used the financial statements to identify potential issues, we can investigate in more detail, which may require additional items from the financial statements and also information that we can't get from the financial statements. For example, on the previous slides, our investigation of the financial statements of XYZ Corporation shows that it has a significant amount of debt compared with its competitors, and the amount of debt is increasing over time. Since this is a concern, we would want to investigate this issue more thoroughly by assessing its ability to make the interest payments on the debt in the future, and by determining management's intentions about increasing or reducing debt in the next few years.